Hi, I'm Bill Spalding. Welcome to WCS Money Tutorials. This video introduces options as an investment. Options are very risky, but you can also earn 2 or 3 times or more of your initial investment within a short time. This video will introduce you to the basics of standardized exchange-traded options that are available in most brokers. Options are securities that give the option holder the right, but not the obligation, to buy or sell an underlying asset for a particular price, called the strike price, within a specified time, ending on the expiration date. There are 2 major types of options, calls and puts. Calls are a type of option that give the holder the right to buy at the strike price. Puts give the holder the right to sell at the strike price. An exchange-traded option is based on a standardized contract. The contract specifies, among other things, the underlying security or other interest, whether it is a call or put, the strike price, expiration date, the multiple of the contract, which for most exchange-traded options equals 100, and whether it is an American or European-style option. So, as an example, a call to buy XYZ stock for $50 per share allows the holder of the call to pay $50 per share for 100 shares of XYZ stock, and requires the writer of the call to sell 100 shares of XYZ stock at the same strike price. A put holder can sell 100 shares of XYZ stock for $50 per share if the option is exercised, and the put writer must buy 100 shares of XYZ stock for $50 per share when assigned the exercise of the option. Most stock options are American style, meaning that they can be exercised at any time before expiration. By contrast, European style options can only be exercised during a short time right before expiration. Options based on indexes, such as the S&P 500 stock index, are European style options. Most options on stocks and exchange-traded funds are American style. When you buy an option, you pay an option premium. The option premium equals the value of the option and consists of 2 components, intrinsic value and time value. The intrinsic value equals the exercise value of the option. For a call, intrinsic value equals the market value of the underlying security price minus the strike price of the call. If the strike price of the call exceeds the market price of the underlying, then the intrinsic value is 0. The intrinsic value of a put is the exact opposite, equal to the strike price minus the price of the underlying security. If the strike price is less than the underlying price, then the intrinsic value of the put is 0. The time value of an option equals the option premium minus its intrinsic value. So if an option does not have intrinsic value, then the option premium consists entirely of time value. There are several option terms regarding value that are often used. An option is said to be in the money if its intrinsic value exceeds 0. If the intrinsic value is less than 0, then it is said to be out of the money. If the intrinsic value equals 0, then the option is said to be at the money and its time value is maximized. Only options that are in the money are exercised. Options that are not exercised expire worthless. Time value varies with both the price of the underlying interest and the time until expiration. Options that are at the money have the maximum time value. Options that are deeply in the money or out of the money have very little time value. Time value also declines as expiration approaches, slowly at first, then quickly in the last remaining week. Although European options cannot be exercised during most of their term, they can be sold, which is usually done anyway, since most options in the money will have some time value left, so selling would yield a higher profit than exercising the option. This is because the value of an exercise equals only its intrinsic value. All time value is lost. This is why most options that are in the money are sold rather than exercised. Only at expiration does exercising become required, but by then the time value equals 0. This graph shows the potential profit and loss for holding or writing a call. You can freeze the screen if you want to study this graph in detail, but the main idea is that if you expect the price of the underlying to go up, then you buy a call. If you expect the price to decline, then you write a call. This graph shows the potential profit and loss for holding or writing a put. If you expect the price of the underlying to decline below the strike price, then you buy a put. If you expect the price not to drop below the strike price, then you write or sell a put. There are 2 types of settlement for the exercise of an option, physical delivery and cash settlement. Physical delivery means that the underlying asset is delivered to the call holder when the call holder pays the strike price. So, for instance, a holder of a call for XYZ stock for a strike price of $10 will receive 100 shares of XYZ stock and pay a total price of $1,000. A holder of a put delivers the underlying security to receive the strike price for that security. Cash settlement means that the holder of the option receives the value of the option in cash. Index options are typically cash settled, since the underlying interest is not a security. In-the-money options are automatically exercised by most brokers, even if they are only in the money by a single penny. So, you must ensure that you have sufficient funds to cover your exercised options. Most brokers will send you alerts on in-the-money options. If you don't have the funds, you must sell the options before expiration. Very few options are exercised. Most option positions are closed before expiration, which is done to minimize losses or to maximize profits. Options that are in the money still have some time value, so it is more profitable to sell the option than it is to exercise it. Furthermore, many option holders probably do not have enough money in their account to exercise the options, so they would have no choice other than to sell it. So, for instance, if you have an option to buy XYZ stock for $100, but you only have $7,000 cash in your account, then your only option is to sell the option. Many times, options will lose so much value that they cannot be resold, since there is no bid price. Most will expire worthless. Occasionally, option contracts are adjusted because of changes in the underlying security, in which case the contract is adjusted so that there is no fundamental change. The most common adjustments are for stock splits. So if a stock splits 2 for 1, then an option contract with a strike price of $50 and a multiple of 100 shares will be adjusted so that the new strike price will be $25 and the new multiple will be 200 shares, so that multiplying the old price by the old multiplier equals the new price multiplied by the new multiplier. Option premiums obviously vary depending on the price of the underlying asset, but option premiums also depend on the volatility of the underlying and on the amount of time remaining until expiration. Volatility and more time until expiration increases the likelihood that the option will go into the money, which is why option premiums are higher for these options. I will briefly discuss the Greeks because they are often discussed in relation to options, although I do not think they are useful to beginning option traders. Several ratios have been developed to measure how option prices change with respect to the price or volatility of the underlying and the rate of time decay. Since 4 of these ratios are represented by Greek letters, delta, gamma, theta, and rho, the group is often referred to simply as the Greeks. Vega is also considered a Greek, although it is not actually a Greek letter. Delta is simply the percentage change in the option premium for each dollar change in the underlying asset. Delta ranges from 0 for options that are far out of the money to plus 100% for calls deep in the money and minus 100% for puts deep in the money. Puts have a negative delta because their value increases as the price of the underlying decreases. Gamma measures the change in delta for each unit of change in the price of the underlying asset. Gamma is at a maximum for at-the-money options and declines towards 0 as the option moves further out of the money or in the money. Theta measures the rate of time decay. The time value decays slowly at first, then most rapidly in the last week before expiration. Vega is the expected change in the option premium due to changes in volatility of the underlying. If the volatility of the underlying asset increases, then its option prices will increase more than would otherwise be the case. Rho measures the change in premiums due to a 1% change in the prevailing risk-free interest rate. Interest rates have very little influence on option prices, so Rho has virtually no use for an option trader. The Greeks are calculated from theoretical prices provided by option pricing models, the most famous of which, and most used, is the Black-Scholes formula. There is no reason for you to know this formula, but it does give you an idea of how the Greeks are calculated. Option prices depend on volatility, because more volatile assets are more likely to go into the money. However, only historical volatility can actually be measured, but since volatility can easily change, historical volatility may not represent current volatility. However, if the other factors of the option pricing model are known, including the market price of the option premium, then an implied volatility can be calculated using the market price of the option. I don't believe that implied volatility is useful in trading options, but it is often discussed in the media. When you look up the price of an option, you will see prices that are much lower than the price of the underlying. This is because listed prices are only for 1 share, but since most option contracts are for 100 shares, the listed price must be multiplied by the multiple to determine the cost of the contract. So if the price is listed as 73 cents and the multiple is 100, then you must pay $73 for the contract. So, the cost of the contract equals the option premium multiplied by the option multiplier, which is usually 100. Most brokers also charge a small commission. Charles Schwab and Fidelity charge 65 cents per contract, while Vanguard charges $1. For example, if the option premium is 50 cents and the contract multiple is 100, then the cost of the contract is $50, and if the commission is 65 cents, then your total cost is $50.65 for one contract. If you buy a call option to buy XYZ stock for $100, then the break-even price per share of XYZ stock will equal strike price plus the option premium plus a small commission. If XYZ stock goes to $120, then you could buy 100 shares of XYZ stock for $10,000, then sell the stock for $12,000 for a net profit of $2,000 minus the premium and the commission. If the market price of XYZ stock drops to $95 right before expiration, then your maximum loss equals the premium paid for the contract plus the small commission. If you buy a put to sell XYZ stock for $100, then your break-even price is $100 minus the 50 cents per share for the option premium minus a small part of the commission. If the market price of XYZ stock is $120, then your maximum loss is $50 plus the small commission. If the market price drops to $95, then you could buy 100 shares for $9,500 and sell it to the put writer for $10,000 for a net profit of $500 minus the premium and the small commission. If you resell the put, then you must subtract another small commission for the sale. I have simplified things a bit. When you buy or sell an option, you do not actually buy or sell to another investor. Rather, you buy or sell to the Options Clearing Corporation, which is the intermediary for the options issued by the OCC, which covers options bought and sold by most investors. This increases the liquidity of options since it eliminates the need for the buyer and seller to interact directly, allowing each to open or close their positions when they want. More importantly, the OCC guarantees the transactions, thereby minimizing counterparty risk. The OCC is the direct participant in every purchase and sale of an option contract. The option writer sells its contract to the OCC and the option buyer buys it from the OCC. As an example of exercising an option, the call holder sends an exercise notice to her broker, who then sends notice of the exercise to the OCC. The OCC delivers the shares to the broker, who puts the shares in the customer's account. The OCC then randomly selects a member firm who is short in the exercise call and assigns the exercise. The broker then delivers the shares to the OCC and assigns the exercise to one of its customers who is short the call, either by random selection or in a first-in, first-out basis. Like most important financial institutions, the OCC is regulated by federal authorities, primarily by the Securities and Exchange Commission. The OCC is owned by the 5 major stock exchanges. The OCC clears most of the standard option contracts in the United States. Most brokers are OCC clearing members, which allows the brokers to execute option trades for their customers. There are numerous types of options available, though equity options are the most traded. Unlike stocks, option trades settle in one business day, although stocks will also start settling in one business day, starting May 28, 2024. Brokers are required to determine if options are suitable for you and that you understand the risks. Most brokers have 4 levels of approval, though this number varies from 3 to 5. This screen shows approval levels for Charles Schwab. The lowest level involves option trades with the lowest risk, including covered calls and covered puts, and buying options, whether as a single trade or as part of a spread. Higher levels allow riskier trades, including selling naked calls and puts, and combinations involving short positions. One requirement for brokerage approval for options is that you must read Characteristics and Risks of Standardized Options, which is published by the OCC, to ensure you understand the risks of trading options. The latest version is available online. The link is provided in the description. Since this video is only an introduction to options, I will briefly discuss option strategies that will be available to most beginners. Although there are many kinds of option strategies, the strategies with the lowest risk involve either buying calls or puts, selling covered calls or covered puts, or selling cash-secured puts. Covered calls are calls you sell where you own the underlying security, so that the call is covered if you are assigned an exercise. A buy-right strategy is similar, except that you buy the underlying security when you sell the call. A covered put is selling a put when you are also short the underlying security. Selling a cash-secured put means that you have the cash to cover the put if the underlying security goes to zero. Long straddles and strangles involve buying calls and puts on the same underlying security. In a long straddle, the strike price of both the call and the put are the same. The maximum loss is the cost of the 2 premiums. A long strangle is the same as a straddle, except that the strike price of the put is lower than the strike price of the call. The maximum loss is the same as the maximum loss for the straddle, the cost of the option premiums. You use a straddle or a strangle if you expect the price of the underlying to move significantly, but you're not sure which way it will go, such as after an earnings report, With the straddle and the strangle, you will profit if the price of the underlying changes significantly, either up or down. Your maximum loss, the two premiums plus their commissions, for both the straddle and the strangle, would occur if the price of the underlying does not move much before expiration. You will sometimes encounter the terms unwinding and rolls. Unwinding is simply closing out a multi-leg position by reversing prior actions, such as selling a call to open, then buying it back to close. Rolls involve closing option positions and replacing them with other options on the same security, but at different strike prices and/or expiration dates. As stated earlier, most investors holding an option position close their position before expiration, which is usually done to take profits or to minimize losses. When you want to buy an option from your broker, you select Buy to Open. To close that position, you select Sell to Close. Your maximum gain is unlimited, but your maximum loss is limited to the option premium plus the small commission. When writing a call or put, you instruct your broker to sell to open, the opposite of opening a long position. To close that position, you instruct your broker to buy to close your position because you are, in effect, buying back the option you sold earlier. Your maximum gain equals the option premium minus the small commission, but your maximum loss equals the price of the underlying. So, if you sold a put on XYZ stock with a strike price of $100, then your maximum loss is $100 per share, since the stock cannot drop below zero. However, if you sell a put on an exchange-traded fund, then your maximum loss will be considerably less than the price, since it is highly unlikely that a basket of securities will drop to zero. You may ask, if the long position has an unlimited gain and the short position has a much higher maximum loss, then why would anybody ever sell options? The reason is because most options expire worthless, so short positions are more likely to make money. This is especially true because the initial option premium consists mostly of time value, which decays over time. To trade options, brokers provide an option ticket, which is different from the form for buying stocks because there are additional selections that must be made to specify the option. This is an option ticket for Charles Schwab. You must specify the underlying security, the expiration date, the strike price, and whether the option is a call or a put. The other information provided by the ticket is like the order form for stocks, including the bid-ask prices, the order type, the limit price if it is a limit order, and whether it is a day order or a good-to-cancel order. Because this is very important, I will repeat this. Note the drop-down box for Select Action. When you buy an option, you select Buy to Open. To close that transaction, you select Sell to Close. When you want to write an option, you select Sell to Open. When you want to close that transaction, you select Buy to Close. Another very important thing to note is the quantity. This quantity refers to the number of contracts, not the number of shares. So the price you will pay is 100 times the number of contracts multiplied by the price. So if you specify a quantity of 1, and the multiple is 100, and the price is $1.95, then your total cost will be $195 plus a 65-cent commission. If you specify the number of shares for the quantity, then your cost would be 100 times greater, which in this case would be $19,500 plus a $65 commission for buying 100 contracts. A big difference from what you probably intended. The Charles Schwab ticket will also display an option chain if you click the chain link. The nice thing about this option chain is that it shows bid-ask prices for both calls and puts. This is the option trading ticket for Fidelity. Notice that it also shows the maximum gain and loss. At the bottom, you can see the total cost, which includes a 65-cent commission. The option chain provided by Fidelity's web platform is much more limited, in that you cannot see the bid-ask prices for the different strikes. However, both Charles Schwab and Fidelity and other brokers provide desktop software that is much more sophisticated and provides much more information, but these software packages are much more complicated, and they are beyond the scope of this video. Notice that you can also select some simple option strategies. Although options can yield tremendous returns, which is why they are so popular, they are also extremely risky. When buying options, you can easily lose 100% of your investment. When selling options, you can easily lose much more than your investment. Although risk can be mitigated by hedging or using option strategies, it is best to avoid strategies unless you thoroughly understand what you're doing. Because it is so easy to lose so much money with options, never use more than a small portion of your capital to trade options. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.